Welcome to the deep dive. Looking through Tokio Marine Holdings' 2024 integrated report, one thing just jumped out at me.
Oh, yeah. What was that?
This amazing stat about their 15-year push to expand outside Japan. It actually worked so well that it softened the blow from huge global events like big natural disasters and the pandemic.
Right. Keeping the profit impact down to around 20 to 30%. That's pretty significant resilience.
Exactly. It really suggests, a very proactive way of thinking about risk, especially for a company in such a, well, traditionally conservative sector.
It really does. So in this deep dive, we're going to unpack that. We'll look closely at their main business areas, dig into the key financials, and explore where they see future growth and how they plan to keep creating value for shareholders.
Okay.
The idea is really to give you, the learner, a solid, clear picture of where Tokio Marine is right now and, importantly, where they're headed.
Great. So let's start with those business segments, that 15-year global risk diversification.
Yeah.
That seems like the place to begin. They really stress how moving beyond Japan has lowered the connection, the risk correlation, with their main Japanese non-life business. That's their P&C, property and casualty. And even though they've got that 20–30% cushion now from major shocks, they're still aiming for more diversification. That says a lot about the kind of massive risks they're managing, doesn't it?
It absolutely does. And what's really interesting, I think, is how they frame that global expansion. It was mostly through M&A, mergers and acquisitions.
Right.
But it wasn't just about spreading risk or boosting profits. They specifically mentioned it brought in crucial expertise, specialist knowledge. That's a huge, well, intangible benefit.
Yeah, that's a great point. And it flows right into their next idea, this global integrated group management. Sounds like they're really focused on making the whole group work together, using the strengths of all the different companies they own.
Like combining product lines, underwriting power, sales networks, really trying to create synergy.
And these synergies, they're not just talk, are they? They put a number on it.
They do. Around $620 million in annual profit contribution as of the end of 2023.
Wow.
And to give that some context, they point out that buying a company making that much profit, say in the North American P&C market, based on average price-to-earnings ratios, how companies are valued that could cost over 1,000,000,000 yen.
So they're basically unlocking massive value internally without the huge price tag of another big acquisition.
Exactly. It's smart. They give examples, too, like cross-selling products across their different companies globally.
And leveraging DFG's asset management. What's DFG again? Quickly.
Right. DFG is their dialogue finance group. They handle asset management for different parts of Tokio Marine.
Got it. So using DFG's skills, optimizing reinsurance deals for the whole group, even buying IT systems together to save money. It all adds up.
And those revenue synergies alone, the ones from cross-selling and using the network, they say those are up to around $900 million now, measured by underwriting premiums.
That's really impressive. Okay, moving to another area, improving disaster resilience. This feels like a really core shift for an insurer.
It does. They're obviously exposed to natural catastrophe risks, but they're looking beyond just paying claims.
Right. Setting up Tokio Marine Resilience back in November 2023. That seems like a major step. They want to be a full-service player in disaster prevention and mitigation, not just cleanup.
Precisely. It's about being proactive, trying to prevent or lessen the impact before disaster strikes, and also helping with recovery after. They're using their own experts, but also teaming up with others, like through that core consortium for disaster prevention.
Core. Yeah, we'll probably touch on that again.
And I think it's quite forward-looking that they're planning, starting this fiscal year, to actually try and quantify the societal value they create through insurance and these resilience efforts.
Measuring their broader impact. That makes sense for stakeholders. Then there's promoting climate action. They seem to be tackling this from, well, multiple angles.
They are. As an insurer, a big institutional investor, and just as a large global company itself.
And GQ plays a big part here.
Yeah, GCube is a major player in ensuring renewable energy projects globally. They work with most of the top renewable companies. Getting into that market early probably gave them a real edge, specialized knowledge.
Makes sense.
And it's not just ensuring green projects. They're actively talking to their big clients, the ones responsible for most of their underwriting emissions, to help them decarbonize.
And that goal, achieving virtually zero greenhouse gas emissions by fiscal 2050. That includes emissions from their clients and investments too, right? That's huge.
It's a very strong commitment. It really shows how the financial sector is increasingly seeing climate change as something they have to address across their entire influence.
Definitely. Their work on supporting healthy and spiritually rich living also shows they're thinking about broader societal issues, not just big disasters.
Tackling things like falling birth rates, aging populations,
Mhm.
developing new products like that, ancient treatment support insurance for lifestyle diseases, and another one called Health Assist coming soon.
Mhm.
It's an interesting strategic path.
And they plan to potentially take these global.
Yeah, refine them in Japan first, then maybe look internationally. Shows a growth focus.
Okay, one thing that seems really key to their M&A success is this business oversight respecting autonomy. They call it their federated model.
That's right. And that ROI, 21.5% on their big deals, is quite something.
It really is. They stress finding the right cultural fit when they buy a company, but then letting that company run with a lot of independence.
Exactly. That federated model means the acquired companies keep a high degree of autonomy. It lets them keep growing using their own strength.
And that builds a good reputation, right?
Yeah,
Makes them more attractive for future deals.
it seems so. Plus, they're not afraid to trim the portfolio. Selling off Highland Insurance Solutions in 2022, for example, shows they're disciplined about focusing on businesses that fit their strategy and deliver consistent returns.
That discipline seems to carry over into their success of human resources thinking, too. M&A isn't just risk diversification, it's talent acquisition.
Absolutely. And their PMI process post-merger integration, how they combine companies respecting the culture and autonomy, seems key to keeping employees engaged. They even mention specific leaders who brought expertise that's now used across the whole group.
Like standardizing best practices. You mentioned TMHCC's expertise in smaller bolt-on acquisitions being rolled out group-wide.
Precisely. It's about leveraging that acquired talent effectively.
And it's not just acquiring talent, but developing it internally, too, right? With things like their Leadership Institute.
Yeah, fostering that culture of growth, aligning everyone with the group's purpose. And they strongly link DE&I, diversity, equity, and inclusion to their growth strategy. It's central, not an afterthought.
People are the core asset. And similarly, enhancement and utilization of intellectual capital, basically, their whole digital transformation push. That's critical today.
Viewing data and digital tech as a competitive advantage. Aiming for global synergies to become a new insurance company. That's a bold vision.
And they're not doing it alone. That core consortium again, over 100 partners, leading to things like that real-time hazard service.
Right, co-creation is a big theme. And their AI adoption seems significant too, that one AI for Tokio Marine tool, what was it, 15,000 users?
Yeah, something like that. 5,000 to 7,000 uses a day. That shows AI is really getting embedded in how they work, boosting productivity. They're even working with robust intelligence on AI risk solutions.
And that last segment piece, enhancement and utilization of social capital via core, really ties it back to using partnerships to tackle societal challenges like disaster prevention.
Okay, so that covers the key business strategies. Let's pivot now. How does all this translate into the financials? What are the key highlights there?
All right, the numbers. Well, first up is ROE, return on equity. They're targeting 14% or higher by fiscal 2026.
Which sounds good, but they admit it's still a bit below some global peers.
Correct. And the main drag they identify, it's those holdings in business-related equities, cross-shareholdings, basically.
And this is a major point. They've been slowly reducing these for years, but now there's a hard deadline. 0 within 6 years.
With a midpoint goal of cutting them in half in the next 3 years, it's a big shift. The plan is clearly to boost ROE by putting that capital into higher return businesses, taking calculated risks, managing capital tightly.
And their adjusted ROE target reflects this.
Yeah, the new midterm plan aims for about 12% adjusted ROE. It's also worth noting their EPS growth, earnings per share. They point out it's been less volatile than peers from 2013 to 2023. Stability is often prized by investors.
And the adjusted net income target.
A CGR compound annual growth rate of at least 7%, but that jumps to 15% or more if you include the expected gains from selling off those equities we just talked about.
Okay, and they break that down by business unit too. Japan P&C is aiming for 5% plus GR, Japan Life 3% plus, International 7% plus.
Right, excluding prior year loss reserve impacts for the international piece. And within Japan P&C, they have specific profit improvement targets for auto and fire lines.
Seems like they're focused on maintaining stable combined ratios. That's a key measure of underwriting profitability in Japan, despite rising disaster risks and inflation. How?
Through proactive premium adjustments and product changes. Makes sense. For TMNF, their main Japanese entity, the 2026 target is an underwriting profit around 2,219 billion yen, aiming for a combined ratio near 92%.
And internationally.
Yeah.
Similar focus on profit.
Yes, underwriting profit CPR around 7%, steady revenue growth about 5%, and that combined ratio also aiming for the low 90s, around 92%. Profitable growth seems key.
What about investment income?
Projected CPR around 8%. That's driven by growing assets under management, or AUM, thanks to cash flows from long-term insurance policies, and also by investing smartly to maintain yield in asset classes with good return potential relative to risk.
Okay, and revenue overall?
Steady growth in premiums coming from both organic expansion and those disciplined acquisitions. They expect that to continue in fiscal 2024, helped by rate increases and sales growth both in Japan and overseas.
So how does this all translate into shareholder value?
Yeah.
Dividends, buybacks?
They're committed to growing dividends per share in line with strong EPS growth. The trend has been upward, and for fiscal 2024, they're projecting 85 to 100 yen per share.
Plus buybacks?
Yep, 120 billion yen announced, with flexibility on how they do it. And crucially, they highlight that their total shareholder return, TSR, has been significantly outperforming their peers.
That outperformance is a strong signal. Let's talk capital policy. How are they managing their capital to hit those ROE goals?
It's all underpinned by ERM enterprise risk management. That's core to how they manage the group. They're constantly looking at risk appetite, return on risk, and diversification.
And the ERM committee has a big role.
Absolutely. Assessing business potential, profitability, risks, then figuring out the best way to allocate capital to optimize the overall risk portfolio. It's a disciplined, risk-based approach. You see in their portfolio reviews and investments, like buying Pure Group or their Canadian operation, always considering diversification and growth.
And that in-out strategy selling businesses too, like Tokio Millennium REIT.
Exactly, focusing the portfolio. Their current ESR, economic solvency ratio, is in the 100-140% range. That's a measure of capital adequacy. And they show how diversification significantly reduces their required risk capital from 7.6 trillion yen pre-diversification down to 3.1 trillion post-diversification for FY 2024 based on their models.
Wow, that's a huge effect. And finally, on financials, that equity divestment plan, again, zero by end of fiscal 2029, half gone in the next 3 years, 600 billion yen planned sale in fiscal 2024. That's a massive strategic move with big financial implications down the line.
Absolutely. It's one of the biggest levers they're pulling. So looking ahead, what are the main engines for Tokio Marine's future growth?
Well, they really emphasize developing leaders internally through that Tokio Marine Group Leadership Institute, investing in people for the long haul.
Fostering that culture of growth you mentioned.
Exactly, and aligning employees with the group's purpose. Plus, those new companies, Tokio Marine Resilience for Disasters, Tokio Marine Smart Mobility for, well, mobility solutions, they see these as key new business drivers.
Right, with the goal for that whole solutions business to become a major revenue stream within 10 years. They're also talking about expanding into new areas, trying different sales models, and really pushing productivity using digital tools and AI.
And a continued focus on disciplined underwriting, prioritizing profit, leveraging the global network, DFT skills, optimizing reinsurance group-wide. Those seem to be ongoing themes for profit contribution.
Of course, there are always challenges and risks.
Definitely. They acknowledge capital is finite, and underwriting alone can't close the huge natural catastrophe protection gap. They're constantly working on their ERM, assessing cyber risks, refining disaster risk management, reviewing reinsurance.
And they list specific risks for FY 2024. Economic fallout from geopolitics, major earthquakes, typhoons, floods linked to climate change, even volcanic eruptions.
We also have to mention the business improvement order from the FSA, the financial regulator, for Tokio Marine and Nichido Fire.
Yes. They state they're committed to preventing recurrence by fixing root causes, mechanisms, systems, awareness, knowledge. This relates partly to issues around fraudulent claims involving Big Motor and some data leakage incidents. They seem to be taking it very seriously.
And interestingly, they also mention a need to fundamentally review some industry practices, like those business-related equities, to ensure fair competition and focus on the, quote, true value of insurance.
That's a significant statement about potential industry shifts.
Switching gears slightly, sustainability seems deeply embedded now, not just a side project.
Very much so. They frame it as integral to their business solving societal issues leads to sustainable growth. Climate action, healthy living support, DEI, innovative solutions, environmental protection, future generations, governance. It's all part of their core strategy, their identified materiality.
That net zero 2050 goal, the interim targets, ensuring renewables, engaging clients on decarbonization, even looking at natural capital and biodiversity in underwriting and investments. It's comprehensive. They've also achieved carbon neutrality for their own operations for 11 years straight.
And on governance, they outline their structure board, audit and supervisory board, various committees. They're working on board diversity and effectiveness, committed to transparency and talking with shareholders. That new global communications department seems aimed at boosting that engagement.
Okay, so wrapping up our deep dive on Tokio Marine's 2024 report, what we've seen is a major global insurer that's, well, strategically diversified, has pretty ambitious growth plans built around integration and risk management, clear financial targets, and a really strong growing commitment to weaving sustainability and societal needs into its actual business.
Yeah, and for you, the learner, the key takeaway should be a much deeper feel for how a company like Tokio Marine navigates this complex, risky world, how they adapt, leverage their strengths, that integrated management, the global diversification, and plan for the long run. Their focus on aligning business with solving societal problems is a really important trend to watch.
Which brings us to a final thought for you to chew on. As Tokio Marine moves decisively to sell off all those business-related equities and really optimizes its capital for higher returns, what kind of ripple effects might that have? Could we see broader shifts in how the whole insurance industry competes? And how might this change the balance for insurers between sticking with tradition and chasing greater financial efficiency?